Warren Buffett is worth around $150 billion today. But here's what almost nobody knows: 99% of that wealth came after his 50th birthday. Think about that. 50 years of investing, and the real fortune came in the last act. I've watched investors for 5 decades. And the single biggest predictor of who builds real wealth isn't intelligence. It isn't income. It isn't even stock-picking skill. It's patience. The ability to delay gratification. To let compounding do the heavy lifting while everyone else is trying to get rich this quarter. Today I'm going to show you the psychology behind why this works, and why most people will never, ever experience it. The last section might change how you think about money for the rest of your life. Here's the thing nobody tells you about compounding. It's not a straight line. It's a curve. And the curve is deceptive. Let me show you. Imagine you invest $10,000 at 10% per year. Pretty standard long-term stock market return. After 10 years, you have about $26,000. Not life-changing. After 20 years, $67,000. Getting better. After 30 years, $174,000. Now we're talking. But here's where it gets interesting. After 40 years, you have $452,000. And after 50 years, $1.17 million. Look at that last stretch. From year 40 to year 50, you gained $721,000. That single decade produced more wealth than the previous 40 years combined. This is the secret. The magic doesn't happen at the beginning. It happens at the end. And if you quit early, or panic sell in year 15, or chase the next hot stock in year 20, you never see the payoff. You miss the part that actually mattered. But here's the problem. Your brain isn't built for this. In 1972, a Stanford psychologist named Walter Mischel ran one of the most famous experiments in history. He sat 4-year-olds down in front of a single marshmallow. And he told them, if you can wait 15 minutes without eating it, you get 2 marshmallows. Some kids ate it in seconds. Some squirmed, sang songs, covered their eyes, and waited. Years later, Mischel tracked these kids. The ones who waited had higher test scores, better careers, healthier relationships, stronger financial habits. Now here's the investing lesson. The market puts a marshmallow in front of you every single day. It whispers, sell now. Take the gain. Lock it in. Or the opposite, buy this hot stock, get rich by Christmas. Don't wait. Don't be boring. And most people? They eat the marshmallow. They trade too often. They chase momentum. They panic during corrections. They think patience is passive, when actually, patience is the most active thing you can do. Buffett once said, the stock market is a device for transferring money from the impatient to the patient. That's not poetry. That's mathematics. Every time an impatient investor sells in fear, a patient investor buys at a discount. Every time a gambler chases the next big thing, a disciplined investor quietly compounds. Let me tell you about a man named Ronald Read. He was a gas station attendant and a janitor at JCPenney in Brattleboro, Vermont. He drove a second-hand Toyota. He wore flannel shirts held together with safety pins. When he died in 2014, at age 92, his estate was worth $8 million. How? He bought shares of solid, boring companies. Procter & Gamble, Johnson & Johnson, J.P. Morgan. And then, he just held them. 4 decades. He reinvested every dividend. He never panicked during the 1987 crash. He didn't sell during the 2000 tech bubble. He didn't flinch during 2008. Now compare that to the average lottery winner. Studies show roughly 70% of lottery winners go bankrupt within a few years. Same money. Completely different outcome. Why? Because one was built slowly, and the other was built impatiently. Ronald Read didn't need to be smart. He didn't need to be lucky. He needed to be patient. And patience is a skill almost no one develops. There's another story like this. Grace Groner. She was a secretary at Abbott Laboratories. In 1935, she bought 3 shares of Abbott stock for $180. $180. That's it. She never sold. She reinvested every dividend. By the time she died in 2010, those 3 shares were worth $7 million. $180 became $7 million. Not through genius. Through time. So how do you actually build patience? Because I won't pretend this is easy. Our brains evolved in environments where tomorrow wasn't guaranteed. Grab the food now. Take the opportunity now. Don't wait. That wiring helped our ancestors survive, and it sabotages modern investors every single day. 3 things that actually work. First, change what you measure. Most people check their portfolio daily. Every dip feels like a crisis. Every spike feels like a chance to sell. But if you only check quarterly or annually, the noise disappears. The signal emerges. You stop reacting and start thinking. Second, automate your investing. Set up automatic monthly contributions. Take the decision out of your hands. When the market crashes, your automation keeps buying at lower prices. When the market soars, your automation keeps buying without FOMO. Discipline beats willpower every single time. Third, define your holding period before you buy. Not after. Ask yourself, am I buying this to hold for 10 years? 20? If the answer is, I don't know, maybe a few months, you're not investing. You're gambling. And the house always wins. Here's the principle I want you to carry with you. Time is the most underrated asset in investing. Not intelligence. Not timing. Not even capital. Time. Because compounding rewards patience exponentially, and punishes impatience the same way. The investor who starts at 25 with $50 a month will almost always beat the investor who starts at 40 with $500 a month. Not by a little. By a lot. The math is unforgiving. The math is beautiful. And the math doesn't care how smart you are. Be the one who waits. Be the second Marshmallow Kid. Be Ronald Reed, not the lottery winner. So here's my question for you. What's the longest you've ever held a single investment? Drop it in the comments. I read every one. And if this changed how you think about time and money, hit subscribe. Tomorrow we're talking about something most investors get completely wrong, the difference between being diversified and being diluted. You won't want to miss it. Remember, this is educational content, not financial advice. Always do your own research. See you tomorrow.